Well, I think it depends on which segment of the market you're referring to. So I would kind of agree with that for the classical cyclical companies that are exposed to discretionary demand. However, for the defensive companies like healthcare, and nowadays I'd include technology in that, I wouldn't agree with it, because I think that we must bear in mind that one of the key drivers of valuation is what is happening to bond yields, high quality bond yields. And we've seen that this huge decline in bond yields over the last couple of years, obviously accelerated this year in the coronavirus crisis. So relative to what's happened to bond yields, I mean, obviously in Europe, we've got negative bond yields, and even in the US, you're looking at something like 70 basis points on the 10-year Treasury. And that is justifying a richer valuation for growth defensive stocks. So my answer is parts of the market have run ahead or too far ahead of the reality. Others are underpinned by what's happening in other asset classes.
Although one of our earlier strategists this morning did make the point that even as TINA has been a dominant theme, and that has encouraged, because of these low yields, people to go into equities, unlike perhaps your bonds or your deposit account, equities do represent the risk of a large capital loss that it may be difficult to get back in this current environment. What advice are you then giving clients around equity positioning?
Well, I mean, the interesting thing is that you can suffer, capital losses in bonds as well. And the interesting thing is that when you're near the lower bound to yields, as you are, say, for example, in Switzerland or potentially Germany or Sweden, then what's quite interesting is you say, well, there's no capital gain there's no potential capital gain, and at some point you could suffer a capital loss in owning these bonds. So what I'm saying is the relative risk of equities and bonds does change when you're at these very, very low yields. Nonetheless, in the short term, it would pay to be relatively defensive in terms of your equity positioning. So if you are going to own equities, then stick with those which are not highly exposed to the economy right now. I think one of the really important things to bear in mind is that this recession we're going through is not a man-made recession or a government-made recession, as some people think. Because the narrative is, look, we shut down the economy, that's what caused the recession. Actually, the reason for the recession is the pandemic. It's a pandemic-made recession. In other words, even without the lockdown, people would have stopped shopping, because people will change their behavior when there is a pandemic around. So while the pandemic is still in play, we're not going to see a return in discretionary spending to the extent that some people